This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 186 for Monday, 1st of May 2017. US markets closed slightly weaker on Friday, marking the 100th day in office for Trump. And during this 100 days, the S&P's gained 5.3%, and since his election in November, the market's gained 11.4%. Earnings season takes off this week with Apple and Facebook reporting. And speaking of Apple, the company outlook remains quite sluggish fundamentally, but investors have pushed the stock ever higher ahead of the new iPhone release in September. Over the last year, the stock has gained some 60%, and this week's reporting is also expected to reveal its cash hoard now exceeds $250 billion. According to Bloomberg, ongoing growth is expected to come not just from upgrade to the iPhone, but more from its services such as Apple Music, Apple Play, and subscription fees from the App Store. Technically, it's hard to argue with a strong trend, although some Type A bearish divergence has been unfolding, creating the current pause. Tuesday's release will provide impetus one way or another. That said, any dips, which are few and far between, are being met with buyer demand, and it would take quite a significant decline down through $138 to consider any deeper correction at this stage. The Global Chart Research Service recently closed a long position for a 30% gain, but it awaits further opportunities. And disclosure, Trish and I continue to hold positions in Apple for ourselves. At the close of the US session, the Dow and S&P were 0.2% lower. Nasdaq was unchanged after being supported by a 4% rise in Google. Commodities firmed. Oil found some support, trading 0.75% higher. Lead, zinc and nickel also traded higher. The Aussie dollar remains below 75 cents. And apart from the plethora of earnings releases this week, the Fed Reserve also meets on Wednesday, but no change in rates is expected. Reporting season has kicked off in Australia today, with Platinum Asset Management announcing a reduction in retail fees, which will impact its earnings by up to 10%. The stock has lost 15% in the last two sessions and is some 47% off its 2016 highs. Another stock on the back foot, literally, is footwear retailer RCG Group, dropping some 25% today. RCG, owner of stores such as Hype DC and Athlete's Foot, slashed full-year guidance by 11%. Problem is, that's the second downgrade in just 3 months. Like the other underperformers, the RCG share price has been tumbling for the last 6 months and is now 66% off its mid-2016 highs. Having a solid defense measure within the rules of your strategy can make a huge difference to your portfolio performance. They'll keep you out of these painful declines like we're seeing in Platinum and RCG and enhance the total return over the longer term. Later this week, we'll have some big names reporting: ANZ, NAB and Macquarie in the banks, and QBE, Woodside, Rio and Santos as well. At the close, the ASX managed to grind out a reasonable day of gains after strength kicked in after lunch. Westpac, NAB and Telstra were the main supporting stocks. CSL has continued to power higher, and there remains reasons to stay bullish longer term, although short-term weakness is feasible. The company is benefiting from plasma supply bottlenecks. As it can increase its supply, it provides investors with solid reliability and strong growth outlook. New product launches add to near-term growth prospects as well, and ongoing acquisitions offer strong gains in synergies. Technically, the stock has now rallied 45% from December, and at this stage there's no sign that a significant retracement is about to kick in. Old resistance, new support has already been retested, which also keeps the door open for the trend to continue. We're in blue sky territory, and there's no high probability target area, meaning we simply have to go with the flow until signs of distribution start to appear. The rise since December extended from a falling wedge pattern that we highlight in this podcast on a regular basis, and a good guideline to remember is that price normally heads up to the origin of the wedge in around half to 1/3 of the time taken for the pattern itself to actually take shape. There's potential for some bearish divergence on the daily in the short term. The trend is exceptionally strong and will continue to run with it, and CSL is currently held in a large cap growth portfolio. And lastly, we're finalising the great keynote speakers for our upcoming trading conference in July. Noosapalooza will showcase a number of industry professionals who will bring original ideas and strategies to our delegates. Now, over 50% of the tickets have already been sold, so if you want to get on board, book early to save and lock in your seat. Visit thecharters.com.au and select Noosapalooza on the top menu. My name's Nick Radge, and I look forward to seeing you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.